gold and the rise of the US dollar. In 1944, in New Hampshire, USA, several nations came into place and created or designed a new international monetary order. And this new international monetary order would replace the pre-world gold standard. So in the Bretton Woods Agreement, the system that was established will be based not only on gold, but also on the US dollar. So the allied nations in place would tie the value of their respective currencies against the US dollar, and in turn, the US dollar would tie its value against gold. And it was around $35 per 1 ounce. That was the price that was tied to. So the expectations with the Bretton Woods Agreement in place, they expected that domestic currencies could fluctuate up to 1%, but also they expected that nations would maintain the exchange rate through domestic economic policies. So because we had fiat money in place, we should also remember that the fiat money is there, but it's pegged against the US dollar, and the US dollar is pegged against the gold. So the exchange rate would fluctuate, but they expected these nations to maintain the exchange rate through domestic economic policies. During the periods of when we had balance of payment surpluses in a respective nation, the respective nation is expected to expand their economy. So during that time, when we have balance of payment surpluses, maybe we have too much gold, we will expect that the respective nation to expand its economy. But during balance of payment deficit, we expect for the respective nation to contract the economy. And this was one of the drawbacks of this Bretton Woods Agreement, because nations failed to expand the economy during balance of payment surpluses and preferred to hold as much gold as possible. And nations also found it difficult to contract their economies and during this balance of payment deficits. But also, as any other system, the Bretton Woods Agreement also had other drawbacks, similar to the gold standard. The annual increase in the global money supply was highly dependent on the annual gold production. So the money supply would only increase if the annual gold production would increase. But also, for other nations, if you take the dollar off, for other nations, their money supply to cover their government deficits, they needed also to for the United States to increase the US dollar supply. And the United States also had its own government deficit. Therefore, if they have their government deficit, they would have to increase the money supply. And increasing the US dollar into the supply, it would also mean that the global money supply, the international money supply, is also increasing. So the international monetary order that was in place regulated that, but the deficit in the United States now became so large that they call into question the Bretton Woods Agreement to undermine the international monetary order. And President Nixon in 1971 took the dollar off gold, and there is where the Bretton Woods system ended. So after the end of the Bretton Woods system, a new system had to be formed. And this is where the Forex market came into existence, because a new system had to be formed, and this system is where central banks allowed for their currencies to float, the exchange rate to change depending on the macroeconomic factors of the nation. So the exchange rate between two countries was allowed to variate depending on the macroeconomic factors of the respective two nations. So with currencies allowed to float freely against one another, that is where trading of currencies came into existence. And that is where trading of currencies became a 24-hour thing. And it could take place in various time zones, the Asian time zone, London time zone, or the New York time zone. And London is placed between the Asian and American time zone. It's all placed to take advantage of the Forex market and has grown to become the world's largest Forex market center. And if you look at the history, if you look at how these markets, how these systems were established, how this, what they were actually finding is to solve what you call the impossible triangle. They are trying to solve the monetary policy independence, exchange rate stability, and free capital mobility within the country. So they needed for the exchange rate to be stable between two nations, but also they needed for capital to flow freely between these two nations, so investment to occur. And also they needed for the monetary policy to be very independent in regulating the exchange rate. So this was the impossible triangle that is being solved, and it is still not solved until today, although we have the existence of the foreign exchange market. So that is how the Forex market came into existence. And with technology, these big banks, these international banks, made it possible for Forex market to be accessed by anyone with a phone or a laptop at anywhere in the world to actually trade this market and profit out of it. And that is where we existed as Forex traders.